All right. Good morning, everybody. Everything is on wait this morning. Everything is on hold. It's all predicated on how the numbers turn out today. There was some negative Apple news due to supply chain disruption, production, and yet even that wasn't enough to move a market where Apple barely moved at all. Since everything is looking at the jobs data this morning. It's really important to realize that if we get back-to-back month, 2 months in a row, that shows inflation is abating, we're likely to see a mad scramble dash to the upside in almost a panic buying situation. So it won't be just some grind higher. It's very likely going to be a parabolic move, much like we saw the other day. There's still a lot of job data or a lot of data to come out in the next week to 2 weeks. I'd say by mid-month, we should have the worst of it, or the bulk of it. Try to find a better way to say it than worst. It's not good, bad, worse, better. It's just data points, right? The 9th, the 13th, and the 14th, PPI, CPI, and FOMC. It's going to be the breaker. Just keep in mind, it's very likely to be unrealistic, right? Completely crazy, mad dash scramble, parabolic, blow off top style move. And the same thing goes the other direction. If we don't get the data the market is looking for, it could send us down a little early, and we end up going into the end of the year headed to the downside. So I was looking through the news this morning, like we talked about. This is what we want to do every morning, and there's really not a whole lot standing out other than this. There was a lot of net outflows last week, kind of hit some record levels. So pretty good articles in Reuters. Keep in mind that today, as I continue to try to stress, this is not a binary outcome where we have to go up or we have to go down. There is a third choice, and the third choice would be that we don't do anything. The numbers for today to keep an eye on is 200,000 in November. We do not have additional auctions today. So once we get past the open, anything through the day today is what we have, other than some Fed speakers. They're going to be going into quiet mode soon. And once they do, we're going to want to keep track of that Nick Tamaros guy on Twitter. He's like the way the Fed communicates when they're in blackout mode is through him. He's in that Twitter Discord that I built. I just labeled him as Fed Whisperer. Anytime the Fed wants to leak, they will use this guy, this Nick Tamaros. This is the world we live in. So your 0 days, since it is Friday, can basically be on anything. You can have them on, um, Tesla, Apple, Microsoft, everything. It's pretty cool. And you're free to do that once we get past the open. We're going to go through the steps of looking at this morning, but keep in mind that when the news comes out, it's very likely going to blast through any pivot points and any structural levels. So I thought we could start out with a little bit of top down. It's something that you should be doing anyways, whether you're a day trader or a swing trader, kind of just looking at the bigger picture. You never know what's out there until you go out there and take a look. Thinkorswim has quarterly. If you're using something like TradingView, you can just tell it to do 3-month or 4-month. So if we look at this, it's going back to 2003. You can see periods in time, say during the 07, 08, 08, 09 housing situation. There was the Christmas surprise of 2018. There was the Trump election. All of that stuff was also, like some taper tantrum, yuan, Brexit, all that kind of stuff. And then we had COVID, obviously, a little bit of a surprise. And now we are trying to soak up some of the money, helicopter money that was donated to the public during the COVID lockdown. These quarterly levels, when I get asked about it all the time, how are you defining your pivot points? Quarterly levels, monthly levels. There is no mad science to drawing a level or a pivot point. Open, high, low, close is still really valuable on every time frame, including and especially the higher time frames. When you find them overlapping, they will have even more weight, especially if it is 3 or 4 or 5 overlapping opens or closes. Open and close on the quarterly seems to be more valuable than the highest point and the lowest point. And if you get more comfortable with your drawing tools, adjusting your line style and using the labels will help you deal with all these lines once you start to zoom into a smaller time frame. So from a top-down approach, looking at the monthly, we're in a brand new month. We had the October, November back-to-back. Looks really good. Still doesn't make up for one single month of September, which we're still inside of. This is IX10 on a monthly. 4175 is going to be a level of difficulty to get through. But even more difficult to get through is going to be 4038. You see how we got an open here and really close to a close there and an open there. And if I was to continue to pull that line back, this is what I was talking about a minute ago when I said when you have multiple open, high, low, close all at the same spot, it becomes a really, really strong level. 4137 is just going to be a really difficult level to get through. And the thing is, that works both ways. So once we get through it, it's going to be a very powerful support. one thing about Fridays is we have next week's expected move. Now, this thing's not set in stone until the end of the day, but that's the range for next week. And this is the range for the current week that we were in, right? That we're not yet done with. Look at the difference between these two. This shows how much the market makers are pricing in for next week, how volatile they believe the market's going to be. Now, this thing is going to continue to move through the day, and then at the end of the day, it'll track from our close, and the gray line will stay put, and then it'll price in the volatility. This indicator was made by a person named Mobius. He's really good at Thinkorswim coding. What he attempted to do was get this. It's the average implied volatility for the series of next Friday. But Thinkorswim code doesn't let us go out here and get this data, right? So we can approximate it a lot of different ways. But when it comes to getting this, there really is no way to access that with Thinkorswim coding. So he did a really good job, but it's handicapped, right? Because it's not necessarily actually coming over here and getting this. Instead, it's using a formula kind of like this to get roughly the same numbers. The point of that is if you come and get it yourself, your lines will be more accurate than that indicator, right? The indicator is not bad. It does a pretty good job, but it's not as good as doing it yourself. So in low volatility times, the indicator is going to work almost exactly like what your hand-drawn lines would look like. But in high volatility times, it's going to be a little off. And the more volatile the market, the more off it's going to be. I'm on the SPX. It doesn't have next week's box yet because the SPX won't print anything until 9:30. I'm looking for something. Just a second. I have to get it off another page. There it is. So this discussion about the expected move and the lines focuses on a static expected move. It's locked in place. We don't focus on the changes of that expected move on a day-to-day or a week-to-week basis. If you want a dynamic expected move, you would want to go in and look at that level every single day. And mark your lines out accordingly. All right, so here I've got the hand-drawn lines, and I've also got the indicator shown. And you can see how far off they are. It's not a minor difference. It's a significant difference. Now, again, in low volatility, the lines are going to be almost on top of each other. They'll be almost exactly the same. But in a high volatility environment, drawing it by hand will be more accurate. It just takes a little bit more work, and you have to do it on Friday afternoon or use the go back, Thinkorswim go back, and get it from Friday afternoon. So for anybody who doesn't have Thinkorswim, you don't have a go back, you got to do it on Friday, and you got to catch it on every single market that you think is important. So through most of the week, we've been waiting to resolve this situation, this IX10 on the weekly, where we had 2 weeks in a row, and we were working on our third week. We finally broke out of it. Since we're talking weekly candles, we actually need this candle to close before we can use this candle in our analysis. But if we close outside of that box at the end of the week today, that's going to be our trigger for the next run up to 42.76. The problem is that 41.37. I showed you where I got it from. I showed you where I drew it at. And I showed you what it's made out of. Open, high, low, close. It's just as simple as that, right? No indicators, no math, no statistics, just an overlap of opens and closes. It's a really important level. It's a solid level of resistance. It's going to be hard to get through there, but we've made it through there before, right? We had that July-August rally. We did make it through that zone before. So it's called an overshoot. The one thing yesterday that got my attention, I was thinking about, opening up a few trades early, was the difference between what was going on in Apple and Microsoft and what was going on in Tesla and Amazon. So looking at the ES or at the SPX, we had this IX10 with the breakout. And the main thing, if you're on a daily, is that in the S&P, we're still inside that really big green candle. Apple, still inside that really big green candle. Same with Microsoft. But not Facebook, Tesla. Well, Amazon's back inside the candle. Netflix is not. Right? So when we go through the monsters of tech or the mega cap, they normally run in sync. If they're bullish, they're all bullish. And if they're bearish, they're all bearish. Some of these have already kept that breakout and expanded well beyond it, like Netflix did. Nvidia it's outside of it, but not by much, not very healthy. But some names didn't get out of that thing at all, just like the S&P didn't get out of it yet. So we're up out of that IX10 on the weekly, but on the daily, a lot of the names and a lot of the indexes are still trapped inside that really big green candle. So I didn't take any positions early. I went ahead and waited, since we have this divergence in our mega cap names. And the thing about the divergence is there's a lot of divergence going on and all over the place. Every analysis tool we have, bullish percent indexes, McClellan summation indexes, energy versus crude, like XLE versus nat gas or XLE versus crude. There's all these divergences right now. Everything we have is showing us conflicting signals. On one side of that, it's because there's this end of year fear of missing out. So we're getting all this bullish flow. But on the other hand, we have no technical signals that say we should be seeing bullish flow. So it's throwing off all the metrics. When I was over on Reuters this morning, I found an article that talked about the outflows and they were pretty big. So it was kind of a surprise there, because the outflows that they track are based on, you know, ETF outflows of the indexes. So today's a critical day for a lot of names. We need some resolution of this divergence. If we get clear, definitive signals this morning and we break to the upside or to the downside, that will be perfect. We'll have a great ending on the week, and we will have a very clear idea of where the heck we're going. But if we get this same sideways, wishy-washy, half an answer, it's going to be yet again another week where we're sitting waiting on data, which would probably be a great time to, you know, consider trades that can take advantage of this sideways waiting situation. Volume is really light. It's what we expect on a day like this when everybody's looking at economic numbers, waiting on economic numbers. I did get a nice trade at the open yesterday. I don't normally trade the open, but this topping pattern going into the open yesterday was so good, couldn't resist. So I took a short here, but I basically got stopped out with commissions right at or right into the open. So I took another one and then ran it down to about 65. So it wasn't bad. It was like from 90 to 65. I think this open today is going to be a little different than that one, right? So if you're unfamiliar with the way this is going to look, we're going to get numbers that will very likely cause this really big bar, kind of like this bar yesterday, right? Where it was really big and then we settled across the top. Now, the thing about a bar like that is we consider it like a gap. And I know it doesn't seem like a gap because, you know, there's candles there. The candle today is probably going to be 3 or 4 times this size. And I'm not even going to say it's red or green. It won't matter. But once it closes, the distance between where we were and where it closed, we want to consider that entire thing a big gap. And that gap needs to be filled. And oftentimes what we see is the market will spend the rest of the day grinding its way back to that point to close the gap. And you can examine that by going back to previous days where there was CPI or PPI or an FOMC. But really the FOMC, you want to set that one aside. It's an afternoon one. We want pre-market data, big job numbers day, and then those 8:30 econ reports that give us these big sweeping candles. This is not a bad example. And when we evaluated this after the event, the discussion was exactly like what we're talking about today. It was a big candle. We had the big sweeping price action. Then once the candle was closed, it just spent all morning first getting it closed and then finally breaking through. But the first thing that it was working on was getting that candle close. And I know, again, it doesn't look like there's anything to close, but this is a liquidity vacuum and vacuums want to be filled. So there's a lot of examples that you can find if you go back looking for them. It's worth doing a little bit of extra work on it. Here's another example. Close the gap. We went from here to here. We spent the rest of the day first getting the gap closed and then, finishing it up. Now, since we know it doesn't have to be some big, massive rally today, it doesn't owe us that. It doesn't really owe us anything. You want to focus on a head fake open. It's one of those mornings where we set a high in the pre-market, we open and then run up to that pre-market high, tag it, and then dump. And a lot of times when it tags it, it overshoots just a little bit and then it dumps, right? It's not a perfect. There's only so many opens, right? There's only so many ways that we can open up. So once you figure out what the main ones are and the most popular ones are, the most profitable ones are, then you kind of get primed up for which ones you're looking for. And it really is just like a mahjong game where you're trying to match today's price or today's pattern to one that you've studied and recognized before. There is no open that you're ever going to see that we haven't had before. And I'm talking indexes, not equities, right? Because equities can have earnings and all kinds of stuff, causes crazy gaps, news, CEOs getting fired and arrested and airplanes falling out of the sky. Talking on the indexes or the sectors, it'll work there too. That you want to match the day to a day that you've seen before, and there will not ever be a day that we haven't already had. So you just got to learn to recognize what every one of the days are. There's not as many as you would think. So it's not some endless collection of days. There's really not very many. So for today, focus on the extremes, because the third choice that we could just stay sideways and not do nothing, there's really not a lot to talk about there. Boring. So instead, let's focus on what if it's really good, right? What if the numbers today confirm what Powell's looking for and shows that all of this damage and destruction has actually accomplished their goals? That's going to pop this market hard and fast to the upside. So how far? First, we have a market maker move to recognize, and it's nearly a 1% market maker move. You remember the other day when we had that big blowout green day, and I said we had the capacity or the potential for a 3% move. On that day, the market maker move was about $25, 25 points. Today, it's nearly 40. So we look at the 1.8 and we add that 0.97. And of course, if we just fiddle the numbers a little bit, we'll steal this 1%, put it over here. So we're looking at a 0.98. Just call it 1%, right? That would give us a market maker move with the ADR combined of 2.8%. So when we look up here and it says 40.51, that's only the ADR. So now we need to add another 1% to this, or another $40. From 41.50, that puts us to 41.90. That's still within our own measured move. That isn't extreme yet. So now we need to know, well, what would extreme be? So 2.8, we cut that in half, it's 1.4. So we want to add 1.4% to this. It's not perfect. Unless you're some Canadian engineer, it's not going to matter. Just get close. 42.50. So we could go to 41.90 without even working hard. And if we get crazy, we could get all the way up to 42.50 and we still wouldn't be considering that too extreme. That would just be extreme 1. I'm going to keep this line and bring it down here. We're going to need it. So that's the top side. That's if everything is really great today. Now we want to focus on what if it's not so great. The ADR to the downside today is 40, basically flat. Take $40 away from 4,000, and that gets us down to 39.60, which we already have a line for, so I'll just keep that. And then from there, we'll use that yellow line that I hijacked from above. And we're looking at 3,900 to the downside today as a slightly extreme move. So from 3,900 all the way up to 4,250. That's big. That would still only be extreme 1. Combined, we're looking at a 4% move to the upside and a 4% move to the downside. And we've actually made 4% moves, right? That's not unique in history. It'll be very, very rare that you ever come across a day that is not in the history books. And when that happens, they talk about it for like weeks. So now you've got your oh dang levels. And from this, we want to focus on the idea of what kind of market conditions are we going to be in. So good or bad, it's very likely to be violent. It's going to push everything in one direction. They talk about a rising tide lifting all boats, and that same tide can fall and all boats would drop at the same time. They never talk about that side, right? Because it's not a cute little phrase that wraps up nicely. But what they're leaning into is a correlated market state. So on the visualize tab, get rid of the heat map, swap it over to the index, pick your index. Now, I like using the S&P 100 and I like using the NASDAQ 100. But there are other indexes that you can bring up, and you can bring up your own watch list. So this thing is pretty powerful. It's also detachable. And you can line these things up pretty nice without taking up a lot of real estate. You're going to want to watch the market advancing versus declining issues and the money flow. to see if we start getting in a highly correlated market environment. We're talking about the NASDAQ 100, which has 101 names in it because Google's in there twice. 95 names is a lot, but that's not what we're looking for. 97 names is a lot, but that's not what we're looking for. We want to see 99, 100, or 101 names, which means every single name in the NASDAQ all moving in the same direction at the same time. And that would just be one market. We want both markets, both indexes. Remember, the S&P has financials in it. The NASDAQ 100 does not have financials in it. And again, it says the S&P 100, but there's more than 100 names there. It's a 101. Highly correlated market state, you're going to want to see 99, 100, or 101 names. In that situation, you don't really have to worry about being some excellent stock picker. You don't have to take 10 minutes to try to evaluate if you're going to take a trade in Tesla or Meta or Nvidia or Apple. In a highly correlated market state, you can just throw a dart. Whatever you go to grab a hold of is going to be moving with the rest of the market. At which point, the only thing you really want to think about is the beta of the thing that you're trading. So on the trade tab, here's your beta. And this is, in simple terms, asking a question that says, if the S&P moves 1%, how much will my market move? And in this case, we're looking at Tesla. For every 1% that the S&P moves, Tesla is very likely going to move 1.46%. So nearly 50% more than the S&P on the day. So if the S&P is measured today to a potential 4% move, and this could move 50% more than that, you're looking at a 6% move in Tesla. But that doesn't kind of work right? Because Tesla moves more than 6% anyways. But it would still be Tesla moves 50% more than the S&P. That's where your fast beta comes in. Now you can choose a different beta on your Thinkorswim to do a front weighted beta measurement or a longer duration beta measurement. The difference between those is the SMA style versus an EMA style. Think of it that way. EMA is front weighted moving average, and an SMA treats the entire data set equally. It doesn't matter which one you pick, just stick with one. Don't swap back and forth. So when the data comes out this morning and everything starts to spike and get all wild and crazy and then settles in, we're going to want to focus on the high side, these extreme levels that we marked out, and then take that over to whatever name you want to trade. Anything that looks like the S&P on the daily chart, anything that's still inside this really big green candle, is going to first have to get outside of that candle, right? If you don't remember the names, you can just kind of jump through the list real quick. the heaviest market cap weight names, say in the NASDAQ or in the S&P, you know, like the top 10 or the top 20. So Amazon's going to have to get outside of that big green candle before it can even start getting bullish. Apple, on the other hand, well, yeah, it's still inside, so it's going to have to also. But you look at something, say, like NVIDIA. NVIDIA is already on the other side of that green candle. It doesn't have that same resistance. Or say Netflix, it's already outside of that big green candle. It's not going to have that resistance. After the day closes, we're going to evaluate that weekly candle. I'll do a write-up on the website. This week's close is very likely going to be the deciding factor of how we get into the end of the year, right? And of course, we still have the CPI, the PPI, the FOMC. But unless we get some surprise out of either of those two data points, today's data point is going to be the last dot plot of concern for the Fed, right? So, I mean, it's going to stick. Something worth looking at is TNX, or the 30-year, the ZB, and TLT. Bonds are picking up. And if you listen to places like Bloomberg and others, a lot of their talking heads are talking about bonds. They're finally catching some flows. If you look at this compared to, say, the S&P, this year we've had a lot of them, a lot of times working together, right? The S&P was going down, bonds were going down at the same time. They're both doing the same thing for a lot of the year. Yeah, TLT is a good one when you don't want to trade the futures, the ZB, because that thing is $1,000 per point, and that's scary. And the ZB runs in fractions of 32, and I mean, nobody likes fractions. Fractions suck. So at least TLT is just a regular thing to trade, right? But if you look at it on the year, here's the SPX on a weekly chart for the year, and here's TLT for the year. And for a lot of the year, we've been moving in the same direction a lot. Yeah, they get pretty scary. So stocks and bonds generally don't move in the same direction, which is why the 60-40 portfolio works well most of the time. But we're in that weird, unprecedented market environment, right? So when we would get a rally in stock, we would get a rally in bonds. When we would continue to sell off in bonds, we were continuing to sell off in stock, right? Same thing. So once we set that October low and we rolled over and began running back up, and we got that head and shoulders, and then we had the measured move, Well, the S&P really struggled to get through this one pivot point and has been, setting that IX10 and giving us a lot of sideways congestion, consolidation, but not bonds, not that 20-year, the TLT, but I mean, even the ZB, right? They're just bonds. Good, clean, single direction price action, right? All buy. Sure, there's some profit taking, but we closed higher on the week after week after week after week. We can see where the money flow is, right? It's kind of the point. So if you're looking at a lot of names right now and they're just not moving around very much, and they're not, we missed some really great moves. And now after having made those big moves, a lot of the names that we would want to trade that have the option liquidity that we would want to participate in, they're not really moving around that much. Or they're herky jerky and they're up one day, down 2 days, and then up 2 days, and it's a mess. But not bonds. Bonds are just continuing to rally with a single direction. Something to consider, right? And of course, it's been running that way for a while, so we're very likely going to pause at some point. But we don't want to just take the other side only because we look at it and say, wow, it's been going up for a long time. Maybe I should short it. Yeah, no, not yet. It needs to actually roll over. I've showed this before, but it's worth pointing out. That bonds broke a level of historic precedent. Thinkorswim doesn't do it justice. Well, that's a long time. Let's try 30 years. That'll do. So I know I'm zoomed out and it's a daily. We couldn't see it on an, if we were actually looking for any detail. But that was a really strong level that broke. Going back, all the way to 2003. We broke through a major level. And it's going to take a long time to fix that. And it might not be fixed anytime soon, right? Like this could take decades to get resolved. But we are coming into some critical resistance on the underside here. So while it's been a good run, it might be worth looking at for some topping pattern, no matter how this data turns out today. Looking at bonds, kind of getting away from the crowded trades that everybody else is in. Tesla, Apple, Microsoft, go down the list. Certainly something to consider. We had a really nice setup yesterday in TLT, and I gave the call out. We were getting an inside day breakout, or a Globex breakout, I should say, not an inside day. So I gave the shout out as we got tangled up right in there. Not a bad follow through. This will have a 0 day today too. just like a lot of the other names. But really, a lot of this is all going to be predicated on the numbers that come out. But you really are going to want to focus on the big move. And as we get past lunch and we get into the later part of the day, no matter how far the market has moved today, don't look at it and think, oh, I'm going to short it now because we've already moved so far in one direction, or I'm going to buy it off these lows because we've already moved so far in one direction. On a day like this, it's not the day to do that. So this big green day that we had, I seen people trying to short it there, and I seen people trying to short it there, and I seen people trying to short it there. And it didn't work for any of them. And it reached our 3% by the end of that day. It actually closed at like 3.08. So good measured move. The market is in this over hyperactive state, high volatility market. So when you look at it and you say, oh, well, it's gone really, really far today, I'm going to go the other direction. Don't do it. Also, the data points that we use, advancing and declining issues, keeping an eye on financials versus big tech and cumulative tick and tick. These things, if we get extreme today, once you get a really extreme reading in this print in these tools, they can't turn around enough to start to show you if things do actually begin going in the other direction. So they won't be helpful. We're still sitting at a really low VIX. And trying to buy VIX for a hedge this year has been worthless, right? It just hasn't worked. Mainly because we're still in a high volatility environment. Sure, we're sitting at 20, and that's low compared to, 35. But 20 is still a really high vol when you look back historically. Plus, there was a couple of big names that got caught manipulating the VIX this year. We mentioned that earlier in the year. Deutsche Bank was one of them. And they're probably going to just get a slap on the wrist and pay some fines. But, it wasn't market paranoia. They actually were caught. If you're looking to trade the VIX to get any kind of hedge, it hasn't been fruitful. Unless you get it at the money. And you time it with, right before an event. Because we haven't had any shocks and all big enough to really spike this thing this year. And that's really the only thing that the VIX is going to pay you for right now is the big ones, the big shock and aws. If it grinds its way up, these options won't change enough to give you value. So insurance is a cost for a reason, right? If you're using the VIX as insurance, you should expect to lose most of the time. Just like when you pay your car insurance or your house insurance, it's just cost, right? You're not paying the house insurance hoping that you're going to get a payback, because the only way you're going to get a payback is if your house gets all jacked up. You don't want the money back. You want your house in good shape. If you're using this for protection or insurance on your portfolio, it's only going to pay you if everything goes straight to hell and your portfolio is getting destroyed. If you're looking for it as just a trade, you're going to want to be more time specific. It's breaking out, it's breaking down, there's momentum behind it, there's actually a signal to trade, not just, well, I'm going to buy VIX for a hedge or for insurance. Those are two different trades. If you go more than 30 days out, match at the money with the VIX futures. So /VX, this is your VIX futures. if I was going to trade, say, March. I'm going to buy options in the VIX for March. At the money is 25.82. So now I would go back to VIX, go to March. 25.82 is at the money, is way out here between 25 and 26. 25 would be in the money, 26 would be out of the money. That's where I would want to trade if I was looking to be at the money in the March series. Skew's picking up a little bit. And volatility on volatility is at least up off of the lows. We could say that. All right, so you guys got the levels. You got everything you need. I will write up on the website this weekend forward outlook after our candle closes on the day. Be careful, be safe, and I'll see you all next week.